Good morning, everybody. We've got Jerry's going to talk here in just a couple of minutes, but before we do that, just going to run through some data that I found here. New data suggests the stock market crash may be imminent. This is October 26, 2020. So this new data tells a scary tale. Aside from the volatility, one thing the stock market isn't short of these days are doomsday predictions. And you're about to hear another one. So everybody's saying, yeah, the market's going to crash, the market's going to crash. But then on the other side, everybody's saying what? Market's going to go up, market's going to go up. Who's saying the market's going to crash versus who's saying the market's going to, well, who's saying the market's going to crash, first of all? Big money or small money? Big money is saying the market's going to crash. And who's go right now? We've talked about them many times. The millennial day traders, right? Exactly right. Previously, I suggested a stock market crash or correction was highly likely because historical data said it was. Following the previous 8 bear markets, dating back to 1960, there were a grand total of 13 correction crashes between 10 to 19% within 3 years of bear market lows. So if we truly did hit a bear market low, which is still a lot of discrepancy in whether we hit that low back March or not, but if we did, then we still are looking for a grand total of 13 corrections, 10 to 19% after that. This is to say that each new bull market underwent 1 or 2 sizable corrections relatively soon after bouncing off a bear market low. However, this is not the most damning evidence that the stock market is in trouble. The most concerning data point comes from Refinitiv Lipper, which has been reporting U.S. weekly mutual fund exchange-traded fund cash flows on a weekly basis for well over a decade. For the week ending October 21st, 2020, investors were net redeemers of funds to the tune of $7.6 billion. So why are the millennials and the stock traders and the day traders in their basement, why are they able to move the market so much in the upward way? Because the market volume is what? Thin, low, exactly. So when the market volume is low, you're going to be able to move the market quite a bit. So it's the fools right here that are moving the market up. What makes this even more worrisome is that outgoing flows come at a time when U.S. Treasury yields are a stone's throw from record lows, 5,000-year lows, right? Investors looking for guaranteed income are scraping at only 0.8% yield on a 10-year Treasury note. So these people, this big money that's leaving, is basically saying what? I'd rather make what? I'd rather make what rather than be in the market? Nothing. I'd rather make nothing than be in the market. What does that say about the danger? And that doesn't even include, as COVID vaccine, Wall Street appears to be expecting the miracle. Why would the S&P 500 be within striking distance of all-time highs? We just talked about why it is. If not expectation of a vaccine with exceptional efficacy. Late-stage trials fail to complete with a wow. Wall Street has a lot of downside. It could wait for a market. Now, this morning, I think it was Pfizer said that they found, or in their first test of 3,000 people, that something with a 90% two vaccine. You have to take it twice. They have a 90% success rate. Now, it's still out. Nobody's looked at that. It's only Pfizer saying that. But even so, why is that a problem? Even if they found a vaccine right now that worked, why is that a problem, at least for the next 12 months? There's 2 problems with that. What's the 2 problems? Yeah, how long does it take? The delay in implementing actually is really the you got both answers there. So first of all, how long does it take to develop 300 doses? A lot. Yeah, Mark, Mark understands some of the deep dive stuff. Yeah, a long time. And the last time, lately, when people have been polled on whether they're going to take the vaccine or not, how many people said they would take the vaccine? Yeah, less than half. So we got a problem with, and a lot of you guys are deep diving. That's awesome. They're talking about, we got a refrigeration requirements, which we don't have up and running yet. So we've got people, the majority of people won't take the vaccine, at least they say they won't. And even if they would, it's going to take a long time to get a vaccine. So is that going to help, is that vaccine going to help the economy in the next 6 to 8 to 10 months? No. Fundamentally, I think it'd be foolish with a small f to overlook the strong likelihood, the strong likelihood of a rise in delinquency rates for mortgages, rent, credit cards, personal loans in the coming months. Remember, funds from the Coronavirus Aid, Relief, Economic Security Act served as a financial buffer for tens of millions through July, but with enhanced unemployment benefits now gone, the unemployment rate still more than double where it was pre-COVID. Our nation's financial institutions are bound to feel the pain. So what are landlords starting to do right now? What are landlords starting to do right now? Yeah, they're panicking, but what are they also doing? Yeah, they're evicting because that protection is no longer there. So that's the fundamental, but let's look at the technical. What does the technical say about the market? Well, this goes all the way back to 1900. So this is your resistance line. This is your support line. Where are we right now? How many times has it bumped that resistance line right here? So for those of you that are technical traders or understand technical indicators, even if we don't have a crash, how much room is there for growth? I mean, when you're down here, how much room is there for growth? Tons. But when we're up here, even if the market did not crash, what are stocks going to make going forward? Not much. It's got to correct, or what has to happen? Either it has to correct or what has to happen. %2 growth? Yeah, well, economic growth, but how much economic growth? A lot or a little? Yeah, enormous. What has to happen in order to break to break through this support line or this resistance line? We'd have to have what? In order to break through, first of all, when it did break through, what happened? This is 1929, guys. When it did break through, what happened? Boom. Biggest crash. I mean, so we are either going to see a correction or we have to have unheard of growth. We have to have growth like we had from 1980 to 2000. What's the likelihood we're going to have growth from like we had in 1980 to 2000? On a scale of 1 to 10, where would we be? Or 0 to 10, where would we be? Ain't going to happen. Steve says, Steve, you really think there's a chance that we would have growth like we had from 1980 to 2000? What would be the engine for that? What could possibly be the engine? Because what was the engine from 1980 to 2000, guys? What made the market grow from 1980 to 2000, and really from 1980 to 2020? What was the Dale's got it. What do you mean by technology, guys? What was something new from 1980 to 2020? The internet, right, Kevin? It was the internet, Ron. So what do we have that's going to have the impact on our economy and the world economy equivalent to the internet? Does anybody have an idea of what that's going to be? Why would blockchain cause the blockchain is a way, it's not, I got 4 blockchains. Guys, is blockchain going to drive the economy the way it is? No, I mean, it's an interrupter, but it has nothing to do with economic growth. How would blockchain create economic growth? It's just a different way of paying for things, guys. So we need the kind of technical indicator what's going to make people do things differently, jobs, manufacturing. I mean, maybe renewable energy, but we're well on our way to that already. So even if that exploded, it's already halfway there. So we're going to see that kind of, yeah, we need new technology. Do we see any new technology? So what I'm just saying is, guys, we're bumping, and the only thing that's going to get us back is either an unbelievable growth in the economy or a correction. So right now, how much money should people be putting into the market, and how much should they have on the sidelines? And the nice thing is about FIAs versus bonds is what? If the market goes up, you'll still make money. The market goes down, you get a reset. Make sense? Julio. So enough of that stuff. So Jerry's got a great idea you want to share with everybody.
Thanks, Mike. Excuse me. Sorry about that, guys. Hey, great to have you guys all on the call this morning. I just want to share with you. I'm going to pull my screen up here. All right, so we can see this here. And occasionally from time to time, we get different tools that'll come out. And I thought that this one would be good to share with you guys and just kind of show a little bit of the power, how it works. I've actually had a couple of you probably over the last year share with me a few reports from this software, but it's called Indexalyzer. And what it is it's an index analyzation software. And there's some boring stuff in here, but I did want to show you guys some of the different details and things that it can do. And there are some helpful chart outputs in there on index annuities that I can get for you guys, and you guys can actually put a practical use for on it, and how some of it can work and how I could use some of it for you guys. And without you guys actually knowing it exists or we have it, there's nothing it can do for you. But I just wanted to show you guys how it works a little bit of the power of it, and a few of the outputs, and how I've had some guys use them already here. So in this software, by the way, there are some outputs that I can get, and I can get them for you, but you can't. This isn't a software if you're thinking, hey, this is something that's awesome, I like this. As an individual agent, they won't allow you to buy it. They'll only let FMOs use this software. So just wanted to give you a heads up on that. But I will show you a couple of the cool things. And we used to have one we used to use called Go Figure Now too as well, that a lot of you guys used to request reports from us on. It does have a couple of tools on there that are similar to that you may see on here that you think are kind of helpful. So just kind of showing right on the onset here. So what they have here is pretty much every carrier's on here, and this is kind of my dashboard, so I can kind of set up the carriers I want to have on here. Because if I want to show some data for some of you guys, some of you may have a broker dealer where you have some limited products that you can use, or whatever the case might be. Maybe for some reason you can't use a particular carrier on there. I could include or omit some of those carriers for you if you're using some of this with a client, so you don't have to have that data on here. It just makes it nice and clean for you. But this is where that's kind of taken care of, and I can kind of maneuver as all the carriers on here. And all of these carriers, pretty much all of the carriers out here, they actually feed actual data on a monthly basis over to Indexalyzer on this. And then also a neat benefit of this as well is, typically, if we do an illustration from a carrier, most of those carrier illustrations are they're up to the calendar year. Whereas with these guys, they actually update the data on all these indexes and get the feeds directly from the carriers, and they do that on a monthly basis. So on a monthly basis, I can go and get that data directly from them. I just download the new Excel spreadsheet from them, which they update on a monthly basis. So you put the carriers in here who I have them all activated on there. And then this area right here, I can go ahead and I can set what states I want, my minimum ratings on here. Do we want annual point-to-point on there? Yes. Do I want biannual point-to-points or 2-year point-to-points? I can put yes. And if I want to eliminate on here, I don't want to see triannual point-to-points or quadruple annual point-to-points or 5-year, I can get rid of that stuff. Now, kind of like Mike was just talking about in a minute anyway, just a minute ago, I prefer 1-year point-to-points. You guys all know me. I've been talking about that for years, simply because we get that annual reset. I mean, that's the power out here. Getting that annual reset, we take advantage of the market going down, and we have to reset and start over at a lower number there. So also on here, I can put in age. We can pretty much put any detail on here we need to, and then I can include whatever type of length of term of product on this list here too as well. So I got pretty much all my lower terms, and I eliminated our 12, 13, 14, 15, 16-year products. But ultimately, what that all comes down to, I'll show you how this can be kind of neat, is it shows me here pretty much all the products here. I can scroll down here on this. Has pretty much right up here, it shows you 1,244. So it crunches the data on 1,244 different options you could have. So all the different products, and then the different crediting methods on here. And then it kind of breaks it down to show me, hey, the 10-year average on this product right over here to the right. And then I can look and see, hey, is it flexible premium, single premium? So when help searching for products, so you may look and say, all right, Jerry, well, how does this help me at all? Well, part of it is I want you to say, hey, here's some of the information I'm looking at when I'm when you come to me and you say, hey, Jerry, I am looking for a product for a particular reason or what have you, this is some of the information that I'm looking at in the background. So I'm not just sticking my my hand into a jar and saying, hey, here's my favorite product, or something like that. There are other things important. Ultimately, with an index annuity, why we're purchasing is because we know we can't lose any money in it, right? But there's other things like the carrier, how well they take care of us when we're using that product in terms of their service, and if the service is terrible, it's a terrible experience for that client, and they don't want to be in there anyway. So there are other things, but this is the data portion of it. So we come up here, I have a handful of products. We got Athene here at the top here. It's claiming here over the last 10 years based on this data, using this NASDAQ SE 2-year point-to-point index, it would have been 11.97% return. So maybe I say, here's some other features on it here. So I'm toggling this by the highest return. Maybe I say, all right, well, my clients, we don't want products that have fees on them. I hate fees. My clients don't want fees. I don't want any opportunity that this thing could go backwards because it's an FIA. Well, what I can do on this, I can just click here. This is the fee section. I say, all right, turn that off. I don't want any products that have fees on here. So boom, it gets rid of it. Now we get up here and we got the F&G Power Accumulator 10 here product. Now it says, all right, a 9.7 return. This is a no fee product. But I could say, all right, well, Jerry, you're right. I can't stand 2-year point-to-point products. I want to run this list here, but I want to have only 1-year point-to-point products. Okay, all right. So I can go over here. I'll take these 2-year point-to-points off. So I'm only going to have 1-year point-to-points on here. Boom. Here we go. Now we have Equitable Denali, a product a lot of you guys have been using here. And that comes up at the top because we've gotten rid of all the 2-year point-to-points on here. So now we have a list of them here, and I can see what we actually have, and it's all 1-year point-to-point. So I say, all right, so I want to be able to go have this data with me here. So then I can go over to my dashboard output, and it actually puts together a nice printable PDF document that I can use. So I may say, hey, I was going to go show this Denali product to my client anyways. I can go show, hey, look, so I am on top of it. This product has historically performed pretty well. I have the data here with it. I can actually put together a little printout for you. Maybe you're looking at 2 different options. Another thing I can do on this, and I say, hey, I want to compare Equitable side by side with Athene. Okay, so I can do that for you too. Here, I could go on our carrier area, and I can just go over to Athene, select yes. I'll go over to Equitable. I can select yes, and I'm going to kind of just set these 2 carriers aside from each other. I'm going to go to a little toggle here so I can look at these 2 individual carriers. And then it's going to update here, and it's going to only have Athene versus Equitable on here, and it's showing all their products with their individual data on here. Let's say, this is way too many carriers. I'm going to confuse the heck out of everything here. I'm just going to look at the top 10 options. So I can change this all the way till I'm looking at, let's say, 25. So it's going to show 25 options on here. And then I can go to my dashboard output. There you go, it has 25 on there. So I can kind of manipulate this and maneuver this around so that what works best if you needed a report, what you wanted to look at, or maybe it's just you want to do a little, looking for products and looking for things yourself, but you want to have things only in a certain criteria. Maybe you just want to see, hey, what are the best S&P strategies? Well, we can flip through and set that up, and I can send this to you, and you can just keep that on you so you kind of know. Maybe I'm not around or whatever, and you just want to know, hey, what are the best S&P options? You got that. So if it's a Saturday and you're going to sell an annuity that day, you're finishing off a case, you already know what you should be going with. So that's one tool. I think that's kind of a neat deal for you there. I can do any of these reports for you. You can't do this part yourself, but I can kind of help you and show you how this could be beneficial and where you could use this. Moving along, a couple other features on this that I think are neat. We have a comparison chart here, and how this works is, and I've done a couple of these for guys already. a lot of us were going back and taking advantage of some of these positive MVAs that are out here. So I know, I mean, we've just done a ton of them where the MVAs are. I've had a lot of you going back, looking through, finding a lot of these old contracts that you've wrote, and I've had some people wondering, hey, you know, is this the right thing? Can I do this? Well, not all the time. Exchanging or replacing a positive MVA case is it the best thing to do? But I've had a ton of cases where it was. Maybe there was a rider on there that we no longer needed. I know a lot of carriers, some of the data out there is that 90% of income riders that are out there don't ever end up getting turned on. There's a ton of them that just don't. And so maybe 7 years ago, this person purchased it. They thought it would be a good idea for them. But I see this many times. All of a sudden, it's not being used in the future, and then they're paying a fee for this. Well, products that don't have income riders on them, just because actuarially how they're built and they don't have that guarantee, you can do a lot better for someone on the growth, and they may have a low, may have something low on there, like a 3% cap. So you can go in, and when you go in there with your client, I don't think most guys don't need this at all. I mean, it's your client. You have good trust. Your clients trust your judgment, and you're trying to do the right thing anyways here. They understand and say, yeah, this makes sense. We should make this move. But I've had some guys who will go in here, all right, so I can go in here, I can put the S&P 500 up here, and then we can grab and put, say, let's see here, a cap of, we'll go 4% on here. We're going to get rid of the fee because we don't have a fee on here. But we have 100% with a 4% cap. And let's say you're going to go ahead and you're going to use we're going to use Equitable. So we're going to use the Barclays Atlas Index here. Well, let's just say the Barclays Trailblazer. We'll go ahead and use that. And it's at 130% participation. The Barclays Trailblazer from F&G. We got it on there. Okay. 130 par on it with 4% cap on S&P 500. We'll go down here. We put $100,000 in here. There we go. We have it. So this was their old product. This is a 10-year look back. Their 4% cap versus Barclays Trailblazer. We can go ahead. We can do the printout here, and you can see based on what they would have gotten compared to their old cap, had we been in here, we're at a 32% gain versus an 80% gain on it. So you're going back, client wants to see, hey, does it make sense? Should I move this? Would have it been better? This can kind of help simplify that replacement when we're going back with your client on that, because we can compare multiple indexes. Maybe they have 3 or 4, maybe they're doing a split between an S&P cap or a monthly average along with, a point to point. We could put all 3 of those indexes in here that they were currently in versus what we're proposing and showing them right now, just on replacing that current option there. And then you can have a little data, to put in the file for the future if you're concerned that, you should be putting in there, hey, the different reasons. And it's not always about the index itself as well. Sometimes there's maybe another, some more liquidity for that client or whatever. But with your own current client there, it's good to be able to have that data that you can put it in the file and just know, hey, we have it in there. Here's what we looked at. We didn't blindly go make the replacement. We did actually take a look and see there was some good reason for that to have that in there. And then kind of lastly here, I'm not going to spend too much time on this feature here, but we have, let me find it here. Okay, this tool right here, I'm a fan of the 1-year point-to-points like I talked about, but I know some of you guys have used some of the 2-year point-to-point strategies because you're trying to get a little bit more yield on some of them, just because it's a tad bit more aggressive and index annuity strategy. Now there is that, the problem with the 2-year point-to-point compared to the one is on the 1-year point-to-point, obviously, we only have a 1-year period, and then we get to take advantage of that annual reset. So that's why I always recommend going with the 1-year point-to-points, because you really get to take advantage of that. Some of you, we've talked about and used that leapfrog method. Some of you have chosen you wanted to do that where you had half of the product in a 2-year point-to-point, half of it in a 1-year, and then after that 1 year comes up, you put that other half into the 2-year point-to-point. So on an annual basis, you always have half the index annuity come and due. Basically, what this will allow me to do is to actually show that leapfrog method, putting part of it in the 2-year point-to-point, part of it in the 1, and what that would actually look at for an annual rate of return for us. So you can do that here and do the printout. And then kind of lastly, one of the last things I kind of like on this is, and I've talked about this in the past, this is they actually track and keep track of the live data on these indexes versus the hypothetical data that's out there. So sometimes carriers will come out with an index and all of a sudden the thing, it looks beautiful. I mean, the carriers want to have it look absolutely phenomenal and awesome out there. And, and it looks great. However, you go in there and you look at it and it's something like this U.S. Innovative Leaders 5 down here, where its live data is actually 0.78. So that means it's almost 8 months of live data. Well, that's not really a lot of that's not very good live data. The hypothetical data is 9.22, and then they can give us a little bit of information as far as how those indexes actually work. Are they tracking trends or what have you on them? But here's the nice thing: you guys don't have to do all this stuff. I'll do some of this for you, but I do have the data to see, hey, what's actually doing good, what's looking good, what's actual live data. Here's some of the work I'm putting in on the in the background that you don't have to do. I can help you with that, myself and Matt, but this is some of the information we have. But there are some of these reports out here I can give you. One that I think is pretty practical for you that I can help you with the same software is, I've had guys when they go do their annual review with their client, maybe they're going back and they're going through their 21-point checklist, but I'll have guys that'll come and they'll say, hey, Jerry, it's anniversary date's coming up. Think I should, make any changes on my index term. Well, typically, the ones that I'm setting you up with, I think are pretty good ones, but sometimes guys want to be able to have a little printout or data when they go into that meeting to look at the index annuity and, say whether or not they should make a change on any of the indexes or not. We do have, and this is something I can get you on pretty much every carrier. So right here, all the carriers have these different downloads I can get you. See, we got pretty much every single carrier on here. And then they get you this report right here that actually shows you the data for all the indexes on that particular product. So this is the Indexalyzer historical performance report for the equitable products, and you can see here equitable Teton 7 shows you all the indexes. You got the annual point-to-point with a cap, you got the annual point-to-point with the participation rate, monthly point-to-point, all their monthly averaging, and then their Barclays Atlas 5 puts it, just kind of shows you what the 10-year historical on that currently is, up to month on that particular product. So this is one that I've had some guys use. I've used these or had guys use these on maybe a suitability that they needed to send something. I've had guys use their reports for that. Or a lot of guys use these on their annual review just to, pop that in the file or have that as a little extra data to be able to go over with that client. So that's pretty much what I wanted to kind of just hammer real quick on. I wanted you guys to know this is available because some of you guys have asked about it. Some of you guys probably don't know that it exists, but I wanted you to see a little bit of what it was capable of. What I'm looking at in the background when I'm looking at products is I do take a look at this information, and that I can get you some of this information if you find a situation where you looked at this and said, hey, I can see where some of this may be helpful for me in a particular situation. But if you're wondering why I may like a particular product or another, some of this data gets into some of the details on why I do or don't like some particular things out there. I'm getting more used to how to use it. So if you have any questions on any of it whatsoever, or want some of these reports or have a couple questions, feel free after the call to give myself a call. And Matt can help you with this stuff too as well, but feel free, maybe you have an idea or there's a way that you could think of where this could be helpful for you that I hadn't thought of yet. But some of those are some of the areas where I think they can be helpful on those annual reviews or some of those replacement situations when you're with a client. So that's pretty much what I got there, Mike.
That's awesome. Thank you, Terry. There's lots of tools in here, guys. Guys, again, there is awesome stuff here. So when we look at those returns, 4, 3, 4, 4. Oh, leave that there, please. Oh. Can we go back?
Yep. There we go.
There you go.
There we go. Okay. So why are these numbers so important? 4, 2.97, 4, 3.6, and again, these are just that one product. Why are those so important right now, guys? Remember last week when we looked at the Shiller tape? What did we say that the likelihood? What's the likelihood of rates of return over the next 10 years? If we look at the Shiller, unless again we have some sort of breakout technology that is similar to the internet. So I guess if somebody invents fusion or makes it work, that would be a breakout technology. That would make energy free. That's the kind of thing that would. But are we anywhere near fusion? Ability to do fusion? No. So why are these numbers important? No negatives. And guys, what do we use the FIA for? What do we use the FIA for? Yeah, there. Oh, Dean's got it. It's way better than bonds or CDs right now. This is way better than bonds or CDs right now. Should we be looking at rates of return of 4 and 3 and 4 for bonds going forward? Is there any way they can do that? Are we going to go? Yeah, so that's the importance. So thank you very much, Jerry. This is a great tool, guys, for lots of reasons. So and especially for your people who love data. Okay, now we can switch, Missy. Thanks. And while she's doing that. So let me get my screen up here. So a lot of you guys have been very bright marketers, and you're going after the unfortunate people who are getting pushed out of their job, early retirement. So, and you've been going after that. Ray down in Oklahoma is going after airline pilots, and Mark's going after, I can't remember who Mark's going after, but Fred's going after AT&T folks that are being forced into early retirement. Are people across the country being forced out right now, guys? And you can provide all sorts of great information for them, because you're not going to just sell them a product. You're going to provide good service, because they got to decide when they are given the option, hey, do you want to take an early retirement, or do you want to roll the dice and maybe a month from now be let go? They need to know, what should I do? So just want to quickly go through, we're not going to belabor this, but quickly go through some of the things that you need to go over with folks on. So first of all, you need to look at how much money they have saved. Is it enough for as young as they are to go forward? How much are they going to get from the buyout? So that's the one thing. And then you want to help them budget for retirement. Not just guesstimate, but crunch the numbers. What do I mean by that? How can you crunch the numbers, guys, for retirement? What is the best way to crunch the numbers for budgeting? What's the best way to do that? To say, oh, I think I'll need $5,000 a month. Is that the way you should do your retirement budgeting? What's the best way to do your retirement budgeting? Well, okay, Mark, but be real. What does that mean? Be real. What do you mean? How do you know the numbers? Yeah, you're right, Mark, but how would you explain it to a client? That's right. Go back to your checkbook, go back to your credit card statement, and do what? Actually write those things down, because it's amazing how much money we all spend that we don't know that we're spending. So make sure, if they're in this situation, they need to know exactly not just what their mortgage is, not just what their car payment is. They need to go actually see how much money have they spent on clothes, how much money have they spent on entertainment, how much money have they spent on going out to eat, how much money have they given the kids, how much. They need to know those numbers exactly. Yeah, cell phone. How much money are they spending on a cell phone? How much money are they spend on cable TV and internet? How much make them go through and do that? Now, the big thing, though, is health insurance. So if they are in danger, even if they have not, if you have clients that are not been pushed out or given the option yet, even so, what should they be doing right now, guys? If they're in danger of it, if it's even a possibility, what should they be doing right now? Get your elective medical procedures done now. If you need a new knee, get a new knee now. If you need whatever it may be, get it done now. Because otherwise, when you leave, are most companies now giving people health insurance when they leave, generously or not? Yeah, they're not. So what are the health insurance options for people if they get early retirement? First and foremost, be sure to factor in the deductible and out-of-pocket. They can do COBRA. Now, the average annual premium for COBRA is $20,000 for family coverage, $7,000 for individual coverage. How much is that going to start biting into people's assets, guys, if they're paying out that kind of money before they turn age 65? A lot or little? That's huge. You can go into the state health insurance marketplace, and the nice thing about that is they comply with the ACA coverage of pre-existing conditions. They make less than $49,000 or $50,000 as an individual, or $67,640 as a couple, they'll qualify for tax credits as well. So they should time the retirement plan withdrawals and Social Security. How much, guys, think about this. Would they be thinking about when they should time their retirement plan withdrawals and taking Social Security to make sure they end up to get some help here? Would they be thinking about that, most people? So these are things that you can really help people with. Does that make sense? So, excuse me a second. Uh-oh. Excuse me. So, yeah, very funny, David. So you can really help people when it comes to this. The other thing they need to decide is, should they take a lump sum or the pension? And you can help them crunch the numbers. How many people are able to crunch the numbers on whether they should take a lump sum or a pension? Heck, how many people can even decide whether to buy a car versus lease a car? You can provide lots of help for folks. I mean, one of the things, if they take the pension, you got to look at is, should they take single life or should they take joint and survivor? And what is this setting you up for, guys? What sale is this setting you up? What kind of a sale is this setting you up for? Single life versus joint when it comes to pension. What kind of a, yeah, life insurance, a pension max life insurance. So helping them do this is going to help you help them and help yourself. Now, the one thing you want to find out is, how is your company's strength rated? Why would that be important, whether you take a pension or not? Because if the company's strength is weak, you don't want to take the pension. You want to take the lump sum and run, right? Also, you want to find out how is the pension funded? Is it an unfunded pension or is it a funded pension? And more as we look at this, what's happening? This is 2019. The dark blue is 80 to 90% funded. And what's starting to happen in just 1 year to the funding of we go from dark blue to light blue, meaning that 80 to 90% funded to 70 to 80% funded. We go from dark blue to light blue. We go from green to dark blue. What direction is it going? Underfunded. Yes. So this is state pensions, but how are corporate pensions doing? Better or the same as the state pensions? They're underfunded as well. So if it's really underfunded, if it's in the 60, 70% range, what would you tell that client? Take the pension or take the lump sum? That's a no-brainer. Even 70, 80, or even if they've downgraded in 1 year, I'm going to go ahead and say, it's not looking good. Because once you make that decision, guess what? Can you go back on that decision? No, it's a one-time thing. So if I see it go in the wrong direction, and really, guys, if push comes to shove, do we really think pensions are going to become more funded going forward? Is there any indication that that's going to happen? No, it's not. You can help them again with Social Security planning. Whether they have a working spouse or not, how to make those decisions. We're going to spend a lot of time doing this, but there are lots of tools out there for you to help clients that they would not understand. And having a working spouse, how much does that affect, and how many different things does that affect on whether you should take the pension or not. It affects it a lot. A lot. Just this chart right here, you could spend a half an hour analyzing just this chart on having a working spouse versus a non-working spouse and how it affects whether you should take your Social Security now, wait till your full retirement age, or whatever it may be. Older, and here's the thing, older works as an age discrimination. If you're 55 years old, what's the likelihood you're going to get a job paying the same as what you were getting paid before? Who are they pushing out? Who are these companies pushing out? The 30-year-old or the 55-year-old? And are they hiring, is any company hiring these 55-year-olds? Yeah, 55-year-old can get a job. Where's he going to get a job? Or where's she going to get a job? Making 90 grand a year or making 40 grand a year? Yeah, at Walmart, lower wages. The other thing they need to determine is, are they a risk taker? I'll give you an example of this. Back in 1999, when I was in Rochester, Mayo Clinic was having a lot of people, they changed their pension plan at that point, Mayo Clinic did. And so we had a lot of people making decisions, do they want the lump sum or do they want the pension? And I had 3 doctors come to me in 1999, and I analyzed their pension. It ended up their pension was going to increase at 9% a year, guaranteed 9% a year. Do you think I told them to take the pension or take the lump sum? Take the pension or lump sum? Pension. I said, you'd be a fool not to take the pension. At 9% guaranteed rate of return for the rest of your life, all 3 of them did not go with me. Why? Why did they not go with me? I was going to make nothing. I was going to make nothing on that lump sum. I was going to work with their other investments, but but they went with somebody else. Why? Because, I don't know if you know this, but Rochester, Minnesota, because the Mayo Clinic's there, it's such a small town, per capita, there's more brokers in that town than 99% of other towns. So what was Merrill Lynch brokers telling them? What was the Smith Barney brokers telling these guys? Remember, it's 1999. What were they telling them? What the hell, 9%? Look at the market the last 3 years has made 25% plus. Are you crazy? Well, what happened to all 3 of those guys? Can you imagine those poor guys? Because where do you think Merrill Lynch and Smith Barney and all the other entities out there, where do you think they put those doctors' monies? My God, if they put them into the NASDAQ, how much did the NASDAQ go back down? And I know for sure I ran into one of them, and guess where they did put him? Tech. This guy, guess what he had to do? He had to. Now, the nice thing is about being a doctor is he could go back to work, but he had to work. He had all these plans of retiring down to Florida, spending summers in Minnesota, winters in Florida, and he had to go back to work because his accounts, that pension that he worked 30 years for, went down 80%. So, because if you just ask, are you a risk taker? What did all 3 of these doctors say? Yeah, we're risk takers. Were they really risk takers? Or were they deciding that based on invalid information? So offer the Social Security analysis, offer the pension analysis, offer the budgeting analysis. Make sure you're make sure all of your clients know what. Make sure all of your clients know what. What should you be calling every single one of your clients and doing right now? What should you be calling every single one of your clients and doing right now? Letting them know that you can do these things for folks. And do they know anybody who's thinking about retirement or who is in danger of losing their job? And that you'd be willing to what? Review these things for them. Does that make sense? Are your clients going to naturally think that you can do these things for their friends, neighbors, relatives? Is that even on their radar right now? No. So tell them you can do these things. Make sense? See, you are needed. Because what are all the other advisors going to do out there right now? And if they land in some other advisor's office, what are they going to do? Are they going to make sure they have, and if you think about this, when you're forced out, do the important documents do the non-financial documents, do they become more important or less important at that point? Even more important. And the rest of the 21-point checklist. So all the other advisors that they would land in are going to do what? Sell, 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 as many of you said, and they're not going to be doing any analysis whatsoever. Guys, you are true advisors. Make sure your clients, not only do they understand it for you, but make sure they understand that you're a true advisor for all their friends, neighbors, and relatives in this troubled time. Does that make sense? Coolio. Well, thanks for being on. Jerry, thanks for the great information today. Lots of great information there. And guys, make sure your clients know that you can help their friends, neighbors, relatives when it comes to early retirement. Make sense? You guys have a great rest of the week, and we'll talk to you all Monday. Thanks, everybody.